Warner Brothers Discovery, trading under the ticker symbol WBD, is at a transformative crossroads. On June 9, 2025, the company announced plans to split into two publicly traded entities by mid-2026, one focused on streaming and studios, and the other encompassing its global networks division, which includes its legacy cable television operations. This strategic separation caused WBD stock to surge over 11% on the day of the announcement, as investors welcomed the potential for better valuation clarity and operational focus. The company aims to isolate its declining linear TV assets from the high-growth streaming business in a bid to unlock shareholder value and create two more strategically coherent businesses. From a fundamental perspective, Warner Brothers Discovery's streaming arm has become increasingly attractive. As of the most recent quarter, the company added approximately 6.4 million new subscribers to its Max platform, bringing the global total to around 117 million. Management has guided toward over 130 million subscribers by the end of 2025, fueled by continued international expansion into territories like the United Kingdom, Germany, and parts of Asia. More importantly, the division has achieved profitability, reporting adjusted EBITDA of over $400 million in the most recent quarter, a sharp turnaround from a $55 million loss in the same quarter the previous year. Analysts now expect the streaming segment to generate over $1.3 billion in EBITDA in 2025, solidifying its status as a credible growth driver. Conversely, the global network segment remains a significant drag. Cable viewership is declining at an accelerated pace, with US households subscribed to cable services falling from nearly 100 million a decade ago to just 60 million today. This has led to a corresponding decline in advertising and affiliate revenue. In the latest quarter, EBITDA for the networks business declined by more than 15% year over year, and this trend is expected to persist. The decision to spin off this unit is an acknowledgement of this structural headwind, and while it may stem further capital drain from the core business, it does not eliminate the risk that this legacy segment could struggle to remain viable on its own. WBD's financial health is mixed. The company is burdened with approximately $34 billion in net debt, and its credit rating has been downgraded to BB's, just below investment grade, by Standard & Poor's. While management is committed to deleveraging, including securing a $17.5 billion bridge loan to assist with the corporate breakup, the debt overhang remains a serious investor concern. Free cash flow has also declined in recent quarters, dropping to under $1 billion versus $1.7 billion in the same period the year prior. Although operational improvements in streaming offer hope, the path to a cleaner balance sheet is still long and fraught with risk. From a technical analysis standpoint, WBD recently broke out of a multi-month downtrend following the breakup announcement. Prior to the news, the stock had been trading in a tight range between $8 and $10 for much of the first half of 2025. The post-announcement rally pushed the stock to nearly $11, above its 50-day and 200-day moving averages, signaling a bullish momentum shift. Relative Strength Index (RSI) readings have climbed above 65, approaching overbought territory, but not yet flashing a reversal warning. Volume on the breakout was significantly above average, indicating strong institutional interest in the news-driven move. Despite the technical breakout, WBD faces resistance in the $12 to $13 range, a zone where the stock previously failed to hold gains in late 2024. If the bullish momentum continues and the company delivers further clarity on its breakup strategy, this resistance could be retested. Conversely, a failure to hold above $10 may see the stock retrace back toward its longer-term support around $9. Options markets have also priced in heightened volatility over the next 6 to 12 months, suggesting traders expect material developments and news flow as the corporate restructuring unfolds. Looking forward, the stock's valuation is another point of contention. WBD currently trades at a forward enterprise value to EBITDA multiple of approximately 6.5, which is a discount to pure-play streaming rivals such as Netflix and Disney's direct-to-consumer segment. Bulls argue that if the breakup allows investors to assign a higher multiple to the streaming division, especially once decoupled from the drag of cable, the sum of the parts valuation could approach $15 to $18 per share. Bears counter that heavy debt, deteriorating free cash flow, and uncertainties surrounding the profitability of streaming at scale may cap upside potential until more evidence emerges. In conclusion, Warner Bros. Discovery is in the midst of a bold and potentially value-creating transformation. The company's streaming division is gaining ground both in user growth and profitability, and the planned separation of the global networks unit could provide a cleaner story to investors. Fundamentally, there is a path to recovery, but it hinges on strong execution, debt reduction, and continued success in the streaming space. Technically, the stock has turned bullish in the short term, but long-term resistance remains. For aggressive investors willing to bet on a successful breakup and the continued rise of streaming, WBD may represent an attractive speculative buy. For more risk-averse investors, waiting until the dust settles post-split may be the more prudent approach.